Good morning, I'm Richard Murphy of Tax Research UK, and I'm speaking on behalf of Tax Research UK this morning and no one else. The reason why I say that is that I've just published a report called Taxing Banks, which has been sponsored by a number of organisations, and it looks at what some people are now calling Robin Hood taxes. I prefer to call them financial transaction taxes. The report addresses a particularly big issue with regard to these taxes, of who actually pays them, and that's what I want to talk about in this video. The technical term for this is tax incidence. It's very clear that if you are charged an income tax, you pay it, and that's the end of the story. When a company is charged to a tax, a lot of economists argue that the companies do not pay that tax, but somebody else pays it instead. The charge is passed on to somebody else, and it is they who they say suffer the incidence. That's the charge for the tax. Well, on a financial transaction tax, the situation is quite complex, and it is quite clear that not all of any tax will be paid by a limited company which has charged it, and banks are limited companies. I accept that point, first of all, from the beginning, and let's not argue about it. Some of this charge will be paid by somebody other than the banks who these taxes are aimed at. There are three sorts of these taxes though, and we should be clear about that. The first is on foreign exchange. It will collect the smallest part of any potential tax. I estimate something like $30+ billion a year around the world. There's taxes on derivatives, swaps, short-term products and bonds. They will raise over $100 billion a year worldwide. And then there are stamp duties on shares. We have one of those in the UK, but extending them on the same basis around the world might raise more than $200 billion a year. They are quite different taxes. They work in slightly different ways because these markets are different, and the incidence will also be different. I want to talk here about taxes on foreign exchange, the pure currency transaction taxes that James Tobin first thought up in 1972, and maybe the taxes on derivatives, interest rate swaps and other such products as well. For all of these, I'm suggesting a very low rate of tax indeed, 0.01%. That's 1/100th of a percent. It's called a basis point in banking terminology. 1/100th of a percent, 0.01%, is one single basis point. And that sounds like an incredibly low rate of tax, but a lot of these deals involve vast amounts of money over very short periods of time, and the margins that are earned on them are only 2, 3, 4% basis points. So 0.202, 0.03 or 0.04%. So the tax is going to be a significant part of the amount of money that is made on these transactions. This I do not deny. In some cases it could be a quarter of the margin. In other cases it's going to be more. In some cases, of course, it will be less as well. But the impact of that is going to be that there is going to be a significant number of fall in these transactions. The work that I've done assumes that the total number of transactions undertaken inside the markets for foreign currency, and let's be clear, here we're talking about the bulk market between banks. Over 40% of these transactions are one bank to another bank, and between banks and very large corporations, the other 57% going on at the moment according to data we have, is almost entirely contained between very large companies and banks, meaning that in total over 60% of all these transactions involve a bank at some point. But of those transactions, some will not take place. I have assumed it's 1/4. In other words, I am assuming that the profit on at least a quarter of the transactions that are undertaken is less than 1 basis point, 1/100th of 1%. So 1/4 of all transactions will not take place as a result of the new tax if it were to arise. Now, this is very important, because what it says is that the banks are going to save the cost of undertaking those transactions. They're not going to employ the staff, who are the fundamental cost of undertaking these transactions, to undertake them, because they're not going to do them. And nor are the counterparties, that is, the very large companies with whom they transact. Now, this is really important for this purpose, because what that is saying is that those people who are employed in this market, which is going to shrink in size by at least a quarter, That's an assumption. Some academic data, by the way, shows that it could be much less than that, but I believe it could be as high as a quarter. Those people are going to have two options. Either they're going to earn a lot less, or there's going to be a lot less of them. Now, either way, we're going to see a significant fall in the amount paid to them. This will incidentally reduce our income tax yield, and I'm fully aware of that. I'm quite happy about that. This activity has been described by Lord Turner, the chair of the Financial Services Authority, as socially useless. I'm quite sure he's right. In which case, we are bound to see those people who are being paid $1 million or more a year to undertake this activity, and at least 10,000 people in the UK are paid £1 million or more a year to undertake this activity. Then they are going to see a substantial fall in their income. Now, they're also going to see a substantial fall in the demand for their services. And the great thing about that, for the rest of us who actually suffer the consequence of these completely unnecessary transactions from which they profit, is that this will see a substantial decline in the demand for their services because banks will not need as many of them. This market for their services has been dramatically overheated because basically these transactions have been significantly undertaxed and significantly underregulated, so they've outgrown their usefulness compared to all other aspects of market activity. And as a consequence, if we see a demand fall for their services, we're going to see a substantial fall in the price of their service as well. Now, my argument about the incidence of this tax is quite simple. These people will see their pay fall dramatically, and none of us are going to cry about that. It is the absolute straightforward policy of governments around the world to attack bankers' bonuses and to cut the pay of bankers, and that is right and proper because these sums are not earned, they are captured by them inappropriately, they are paid excessively, and we should see their income fall. If their income falls by at least a quarter, that will be enough to pay the tax. Actually, of course, the tax will still have to be paid out of the remaining margin. And we will have seen the total revenues inside this activity, because profit has disappeared from a quarter of it, fall to 75%. The tax left over may be 1 basis point on an average of at least 3 basis point margins. That could be up to 1/3 of the total margin left in the activity. So let's call that 1 basis point out of the remaining 3 on every transaction. To keep these transactions profitable still, then the banks are going to still have to cut their costs to undertake the activity, which they will because there are people who want to trade with them. The large companies who undertake these trades do so because they need to hedge, they need to undertake these forms of foreign exchange transaction to undertake their trade. So they will actually want to buy the service. The bank will want to still supply the service, but they will cut their costs to do so. That means there will be a double pressure upon the pay of those who are engaged in this activity. I call this a perverse paradox, because what will actually happen is that because of the reduced demand, we will see a dramatic cut in the pay paid to those engaged in this activity, sufficient almost certainly to absorb a large part of the total cost of any tax paid. The remaining part will come out of the profits of the banks. We know that the banks have more than sufficient profit to do this. I estimate they have capacity to pay transaction taxes of more than 70 billion a year, and that is before they achieve the benefit of cutting the costs of the pay made to those undertaking the trades. The consequence is that because of this perverse paradox, at the moment we impose a tax, the volume of transactions falls dramatically, the demand for those working in this sector falls dramatically, their pay falls dramatically, and therefore the profitability of the trades is maintained, ensuring that the banks can still provide the service but at much lower cost. We end up with a tax being paid at cost very largely to bank profit and to the excessive pay of bankers. A very small part will almost certainly leak out into the finance departments of the largest couple of hundred companies in the world who undertake most of these transactions with the banks, and that will be highly diversified. Their risk will be reduced. The benefit of that reduced risk, because they excessively trade in these transactions at the moment, will be reduced risk to shareholders, and there's ample evidence that these trades have actually not benefited shareholders in a very large number of cases. And the consequence will be that for them, the value of their shares will rise for 2 reasons. 1, their risk will be reduced, and 2, their cost of undertaking these transactions with banks will fall, because the cost of the banks for supplying this service will fall because the cost of their employees will fall. This perverse paradox means that actually not only will the tax be paid, but the incidence will actually fall entirely on bankers and banks, and the rest of us will all be better off. Those who argue that this tax, with regard to currency transactions and with regard to derivatives and swaps and other transactions, will actually fall on ordinary people are simply wrong. They've only looked at the incidence of the tax. Actually, what I'm arguing here is that the incidence of the profits that gave rise to the tax in the first place was so perversely unjust and created such a perverse incentive to overpay bankers that it is actually absolutely correct now to eliminate that perverse incentive, apply the perverse paradox that a financial transaction tax will create of providing benefit whilst enhancing tax revenues, and will reduce the pay of bankers. It's a massive advantage for society, and I strongly urge the introduction of financial transaction taxes for this benefit for all of us.